would speak to one or two things on chapter 3, which predominantly maybe comes as financial data analysis. And it's a major topic especially after the chapter 2. We've looked at chapter 2 and 3 are major topics. So I would suggest you pay attention, rapt attention, and let's pick one or two thoughts on the papers, on the topic, on the chapter. Okay, so we have the content, which is quite much, and we'll be looking at the purpose and a brief introduction. We'll be looking at the meaning of financial data analysis. We'll look at financial data analysis tools. The fourth unit to be looking at performing accurate calculations in financial data analysis. The fifth unit to be looking at evaluation of all assumptions in financial data analysis. Then our professional skepticism. Then the numbers, which are mostly techniques, strategic management tools, performance management techniques, and sensitivity analysis. Then also plausibility and numerical output, how to speak to them in communicating our thoughts from the numbers to the letters. The ninth unit will be interpreting the results and reconciliation of the numbers. Then finally, making financial decisions, which is critical and very, very important. Your conclusion and your recommendation. Then how do we use financial data analysis in the case study exam? So 11 units, we'll be looking at them one by one. So what is the purpose of financial data analysis in the case study exams? So is to understand how to use it in the exams, then how to use the tools. So financial data analysis is a tool you use to interpret what is like a vehicle that carries information to your clients. So that tool needs to be understood and how to use it, and also to make conclusions and recommendations based on the tools you have used and calculated based on the data provided to you, and using that output to communicate for decision making to your clients. So that's essentially the purpose of financial data analysis. Okay, so by way of introduction, chartered accountants and candidates on the way to qualifying as chartered accountants, we are required to provide capable decision support system to management. We are like supporters, advisors. We need to support them in operational and strategic context. And that area focuses on management accounting, performance management, linking costing and management accounting, and also quantitative methods to critical success factors, and also for them to be able to achieve organizational objectives. So whether it's financial or operational or for a social purpose, take note that we provide decision support. So we are more of a decision support system for management. Chartered accountants help them interpret data, complex calculations. Remember, most of our clients may not have financial literacy. So we are there to provide that bridge between the numbers and the explanation. And the critical area of management accounting, linking costing and management accounting, and also quantitative techniques to help them achieve operational, practical, and strategic objectives is very important. So in the case study examinations, we are expected to be capable of analyzing the financial and the non-financial data, and every other information that relates to the exhibits or that is brought by the form of exhibits to make support, to support management's decision. You see, these numbers and our communication of the same will help them make decisions that would cause a shift in their business landscape. This is very important. So in the business space, we are there as decision support systems, and chartered accountants are seen as trusted advisors. So this is key in understanding our role, not just to pass the case study exams, but when you get to the office, you see that As you report to the board of directors, you report to a supervisor, you report to management, they will need your expertise to make decisions. This is very important. So that's generally introducing the unit, and that brief introduction will take us to Unit 2, the meaning, of financial data analysis. What is financial data analysis? Financial data analysis is the process of identifying and analyzing financial data to solve a financial issue, or like I said, support management decision. Very simple. Solve a financial issue or support management's decision processes. And we need to be skilled, and part of the training we are going to is getting the skills to be able to understand the request, which is in form of a requirement, and use the appropriate tools, MPVs, the sensitivity analysis, performance management, all those tools, professional tools, to perform accurate calculations, evaluate our assumptions, and interpret, which is very important, interpretation of the results, to make clear recommendations for management. And that is what we are skillfully learning in these processes, to use these appropriate tools, perform calculations, evaluate our assumptions, and interpret the results to make clear recommendations to management or our clients. Very important. So very key is communication. Communication is key in financial data analysis, and in generally our quest to passing case study, communication is very important. It's not a computation paper or a calculation paper. It's a communication or a writing paper. That's why gurus in calculation find it a bit challenging with case study. People that are very good in computation, SFM, CR, ATAX, most of them find case study challenging if they don't understand the technique. So it's not a calculation paper. Your communication is key, and it takes over 80 to 90% of the marks. So the way to understand non-financial audience is important as the calculation itself. So you have a non-financial audience, maybe very few people on your board or your management team that know accounting or finances. So you don't just report numbers. You need to explain what they mean. Very important. We need to explain what the numbers mean and not just communicating numbers. So communication is key. We cannot overemphasize this. So that's the meaning of financial data analysis in brief. And we move to the third unit, which is financial data analysis tools. So the core idea is that we are expected to know and apply tools from other subjects we've treated in the foundation paper, our quantitative methods for those that wrote foundation, then for those that wrote skills, performance management, financial reporting, CSME, taxation. So all those people will bring to bear. So the exam won't tell you which tool to use. Like the last November 2019 we just saw data provided. They didn't say use NPV analysis. So you could decide to use NPV, you could use IRR, you could use payback period. So the exam won't tell you which tool to use. So you must use your judgment. That is where our judgment comes in. Once you see the numbers from your experience, from the other papers you've written in the ICAN, you just decipher and comprehensively pick the tool. It's also an examination process. So you must use your judgment to select the most appropriate one for the situation. This is very, very important. So take note of that. That's the idea of financial data analysis tools and the employment of the same in the examination of case study. So common tools we'll be covering includes forecasting, budgeting, financial appraisal, break-even analysis, product mix decisions, project appraisal, business valuation, and so many others. So you need to take note of the fact that the case study exams always focuses on a current issue and an imminent decision. It's a current issue, it's not historical information. The case study exams focus on a current issue. So the exhibits, the cases provided to us are current issues bedeviling a client or a company. So if the information is missing, we need to make sensible assumptions and state them clearly. And that is why you see we came up with limitations of the study. So there are some things that are missing that may hamper or restrict our scope or the general landscape of the question we are treating. So some information may be missing, could make assumptions, and we could state the restrictions, the limitations very, very explicitly. So take note in the examinations, you are often provided with a current issue, and it needs your decision. Very important. Okay, so let's look at the first section of the tools, financial data analysis tools, financial forecasting and budgeting. Financial forecasting is a broad term for calculating future results to support a decision. So financial forecasting is being futuristic in your approach. You are projecting the future. So you are having the result of the present and you are using it to project the future. For example, you're currently doing a revenue of 500,000 naira and you're hoping or forecasting to do 10% of that in the next year. So 10% of 500,000 is 50,000. So let's say we're in 2025 and our year result was 500,000. By 10%, we want to have 10% financial growth in 2026. So our forecasted revenue will be 550 based on that 10% percentage we are forecasting. So it's a broad term, just using that example to provide a broad term of what financial forecasting is. It's to help support decisions and be futuristic in your plan. Very important. And the characteristic is that it determines resource allocation. So financial forecasts are updated regularly. And we can have short-term financial forecast and long-term financial forecast, which helps management to take immediate decision. Very important. So that's a tool that we use in financial data analysis. So key factors in financial forecasting is to consider the subject. The subject, what are you doing? What area of the financial are you looking at? Is it revenue? Is it cost? Is it profit? So what's the subject? What is the source of information? Is it from historical information or from present information? And it requires accuracy. You look at the materiality. What's the magnitude of the numbers? And what's the time frame you want to cover? So these are the key factors when you are forecasting or you're using the tool called forecasting. All right, we'll look at the next one, which is budgeting. There are two different tools in financial data analysis. Budgeting. Budgeting is a detailed plan of income and expenditure for a future period, usually just 1 year. So forecasting could be short term, 1 year, then long term, 5 years. We've seen questions provided of forecast in past questions of the case study where you are asked to forecast for 5 years. You can't budget for 5 years. You can only budget usually for 1 year. So those are the major difference between forecasting and budgeting. It's a detailed plan of income and expenditure, but forecast you could look at revenue, cost, and every other component of the financial statement, the cash flow. You could do cash budgeting, you could do revenue budgets, and several budgets. And also forecast, you could also forecast different areas for a long-term period, 5, 10 years. But for budgets, usually it's 1 year because you need to see the results of what you've done this year and move to the next year. So what are the purpose of budget? Is to set financial targets. So financial targets are the purposes or the purpose of budgeting. Set financial targets to measure your performance by comparing your budgets with actual results. And that is an analysis we've done in performance management, which is variance analysis. So your budgeted versus your actual is the variance analysis we perform on our budget, which is very important. So we have we have the approaches to the budget, speaking to the top down or top down and bottom up budget. So we have the top down, speaking to upper management sets the budget and cascades it down to other departments without their input. So management makes the budget from the top at strategic level or at board level and sends the budget down for implementation to the middle and the lower cadre managers. Then we have the bottom up, where the departments are to supply data and their inputs, their requirements and whatever it's their needs, and it's incorporated into the budget and taken up for approval and management ratification. So these are the two approaches of budgeting. We have top down, where the budget is coming from up without the management or the middle or lower cadre managers having any input. But we have the bottoms up, which is generally the popular budget, where everyone from down provides input and it goes up for scrutiny and ratification. So that's it for financial forecasting and budgeting. Please, if you have any questions, interject freely. So the second section under the financial data analysis unit is financial appraisal and reporting. Financial appraisal and reporting. And the purpose of financial appraisals and reporting speaks to the fact that the analysis and report on a specific event or change is what financial appraisal is all about. The analysis of a report and specific event or a change that occurs. So for example, a problem or a price change. Prices have changed because of raw materials and the product we are producing, the price of the finished goods need to change. And this is to support further discussion or reporting. So that's essentially what financial appraisal and reporting means, or the purpose of it. So areas like credit facilities. This is a specific type of appraisal or financial appraisal used to assess a company's ability to service debt. So that key tool, especially for banks, looking at the debt service coverage ratio, DSCR, is usually used to decide a loan. A bank uses it to appraise a project or a customer. And that's where financial appraisal and that area of credit facility is used to look at the viability, look at a customer's creditworthiness. Mostly you are appraising to see if you can provide a loan and if he's able to return it, or the company is able to return it, company or individual. And you're essentially financially appraising the person in that sense. So for the key factors, financial appraisal is the same for, as we've spoken to financial forecasting. You have to look at the provenance, which is the source, the accuracy and materiality of the financial appraisal in what decision you're about to make for it. So it's very important. And after financial appraisal, it culminates in financial reporting. After you've appraised the person, you either grant the loan or not and report back to those charged with governance or those you're working for on what you have appraised and the decision you've made, or for them to make a decision on that. That's essentially what reporting is all about. Okay, so that's speaking graphically to financial appraisals and reporting. Let's look at break-even analysis. Break-even analysis. Well, this may be a longer tool to analyze, but then we have like 8 minutes more. We may go beyond 8 minutes because this is longer in our analysis. So let's have a soft landing here on break-even and CVP analysis. We this session is going to be longer and it will take more than 8 minutes, and I don't want to keep us more than 10 p.m. So I would like to stop here on this note, and we'll continue in the next class so that when we take the break-even analysis, we won't stop halfway or middle way and extend the time of our lectures. So I'll stop here in the next 7 minutes. We can either halt, or if you have any questions, general or specific to chapter 3,